Hello and welcome to Earnings Echo. We put together the most important information about DoorDash.
Let's get right into the Q4 2025 numbers.
Management is throwing around the word record for this performance, but whenever I hear record, I get a bit skeptical. Are they actually healthier, or are they just getting bigger by buying up competitors like Deliveroo?
It's a fair question, but looking at the hard data, the health is completely real. Top line is massive. Revenue came in at $3.955 billion.
Which is a 38% increase year over year, right?
Exactly. And even if you strip out that Deliveroo acquisition, the organic engine is humming. Total orders increased 20% entirely on their own.
Okay, so people are still ordering more food, but are they making money on it? Because usually this is where we see those classic growth at all costs losses.
Not this time around. They posted GAAP net income of $213 million. That is actual profit, resulting in a diluted EPS of $0.48.
That definitely shifts the narrative. And I saw the board authorize a $5 billion share repurchase program.
Right? And they haven't even used it as of mid-February. It's just a serious flex to show you they have the cash flow if they need to deploy it.
Analysts must be loving the top-line growth driven by that consumer engagement. But we know the restaurant delivery game is mature. To keep this valuation, they need growth elsewhere. How are the new verticals doing?
This is frankly the most critical takeaway from the whole report. For years, the narrative was that delivering low-margin items like groceries was just a cash incinerator.
Because picking items off shelves is incredibly labor-intensive.
Precisely. But CFO Ravi Inukanda dropped a bombshell. He projected that the entire grocery and retail business will be unit economic positive by the second half of 2026.
Let's clarify unit economic positive for you listening. It means they stop losing money on every individual delivery.
Yes. Once they cover the cost of the driver and the transaction, the rest is pure contribution to the bottom line. If they flip that switch on grocery, the valuation model changes completely.
And this applies to their international business, excluding delivery, right?
Correct. That is also expected to be contribution profit positive in the second half of 2026.
That helps explain the margin improvement. But surely the advertising business is playing a major role here, too.
A huge role. Think of ads as the high-margin subsidy for the low-margin deliveries. Following the Symbiosis acquisition, the number of advertisers doubled and revenue tripled.
Which pushed Q4 gross margin up to 48.3% with a net revenue margin of 13.3%. The business is clearly working.
It is. But moving to the earnings call, CEO Tony Zhu spent a lot of time talking about systems versus products, emphasizing the sheer complexity of orchestrating local commerce.
It sounded a bit like corporate philosophy. Was there a real warning buried in there regarding macroeconomic risks?
It was a warning about operational headwinds, specifically the friction of running a Frankenstack. Right now they have the DoorDash tech, the Wolt tech, and the Deliveroo tech all running completely separately.
That sounds wildly expensive to maintain.
It is. They are starting a massive platform modernization to merge it all into a single stack. Management warned that 2026 will have redundant costs while they migrate.
Because they have to pay for double the servers and engineers during the transition. Is it worth the short-term margin hit?
Long-term, yes. Increased velocity in feature development. Once consolidated, if they code a new feature, they ship it globally instantly.
So what does that mean for the guidance?
Ravi Inukanda expects the full year 2026 EBITDA margin to be up slightly versus 2025 excluding Deliveroo, and Deliveroo itself should contribute roughly $200 million in EBITDA.
Speaking of innovation, we also heard about DoorDash Dot, a purpose-built autonomous vehicle.
The vehicle is neat, but the real innovation is the autonomous delivery platform. It's the software managing handoffs between AVs and human dashers.
It makes them agnostic to labor costs as long as the software controls the flow. Let's bring it home. What is the core echo you need to take away today?
DoorDash is transitioning from a food delivery app to a multi-product local commerce system. The critical takeaway is that inflection point of profitability in H2 2026.
The bleed from expansion is finally ending.
Exactly. They are shifting toward profit generation in new verticals alongside the core restaurant business.
A clear evolution. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.